Good day, everyone. Hope you're enjoying your day. So I looked at IDVO earlier, and second income ETF that I purchased today that did a bit of research on recently was it's a Energy Select Sector SPDR XLEI is the ticker symbol, and it is an income ETF. And it's another one of those income ETFs that pays monthly, and it is focused on the energy sector. So you got a lot of like oil companies, you got any type of energy company. It's 100% energy companies. Um, you know, so it's a premium income ETF, and it's got the majority of its holdings are XLE. XLE top 10 holdings are ExxonMobil, Chevron, those two right there are the top two holdings. 22.12, 16.60%. And you got ConocoPhillips, SLBNV, with the Williams Companies, Valero, Marathon, EOG, Phillips 66, and Baker Hughes Company. 100% of the XLEI is in energy. The reason why I picked, the reason why I like this ETF, XLEI, we're looking at XLEI right now. This income ETF has done well. It's got a healthy return of capital, and it's done a good job maintaining its NAV. Today it dropped a little bit, but over the course of, let's see, look at the course of 1 year, it's increased. It was at 20, or it's actually stayed the same. It was at 20. Let's see here. We got looking at 27/31/2025. Closed at 24.85, and then on so today closed at 25.9. So it increased a little over 4%. Or about 3.39% over the course of a year. 5 years, it's also done a good job maintaining its NAV. It hasn't been around a year. It's only been it began like towards the end of July last year, and it's gone. So it hasn't been around a year. So but in the course of a year, it's done a good job maintaining its NAV, and the ROC is healthy. So and it actually has quite a high monthly dividend. I'll get to that. Anyway, so I asked, Copilot, could you tell me about XLEI ETF? The answer is XLEI is State Street's new premium income version of the classic energy select sector SPDR XLE. Essentially, XLE plus a systemic covered call overlay designed to generate high monthly income. It launched July 30th, 2025, so it's still a young fund with limited long-term data, but we now have enough detail to give you a full picture. What XLEI is. XLEI, State Street Energy Select Sector SPDR Premium Income ETF, is an option income ETF that holds XLE, the Standard Energy Select Sector SPDR ETF, as its core exposure, systematically sells call options on XLE to generate premium income, concentrates entirely on S&P 500 energy companies, targets high monthly distributions, current yield 16.85% as of June 2026. This makes it similar in structure to JP Morgan's JEPI or JEPQ or Global X's covered call ETFs, but focuses specifically on the energy sector. Key facts. The ticker symbol is XLEI. Inception is July 29th, July 30th, 2025. Expense ratio is 0.35%, and that's on the lower end of a lot of these covered call expense ratios. Net assets, $30 million, still small. Dividend yield, 16.85%, driven by options premiums. Distribution frequency, monthly. Category option income, covered call ETF. Underlying exposure, 100% U.S. energy sector via XLE. How it works. XLEI invests at least 80% of assets in XLE shares, the underlying energy ETF, short call options on XLE to generate income. The fund systematically writes call options with less than 1 year expirations to harvest premium. This boosts yield but caps upside when energy stocks rally. What's inside? The holdings. XLE is essentially a wrapper around XLE, whose top holdings include, I went over this earlier, ExxonMobil, Chevron, ConocoPhillips, SLB, Valero, Marathon Petroleum, Williams Company, Phillips 66. XLEI's own holdings list shows 101% XLE exposure plus short call positions. And performance snapshot. Because XLEI is new, only short-term performance is available. Year to date, 2026, 18.1%. 1 year, 5.7%. Reflects capped upside in strong energy markets. Covered call ETFs typically underperform in strong bull markets because upside is capped, but outperform in flat or choppy markets due to premium income. Who XLEI is for? XLEI fits investors who want high monthly income from the energy sector, lower volatility than pure energy equities, a rules-based covered call strategy, exposure to large cap U.S. energy companies. It is not ideal for investors seeking maximum upside in energy bull markets like the last few months, broad diversification, long performance history, large, highly liquid funds. XLEI is still small. XLEI versus XLE, quick comparison. The XLEI has a covered call income. XLE is pure energy sector exposure. Yield is 16.9% for XLEI. XLE, 2.26%. Expense ratio, 0.35% for XLEI. XLE is 0.08%. Upside potential is capped for XLEI. XLE, full upside. Volatility, lower for XLEI compared to XLE, which is higher volatility. And XLEI is best for income. XLE is best for growth, beta exposure. And bottom line, XLEI is a high income energy sector covered call ETF built on top of XLE. It offers very high yield but limited upside, making it suitable for income-focused investors who want exposure to oil and gas without the full volatility of the sector. So where did I go next? So I asked, does XLEI utilize ROC distributions, return of capital distributions? And I wanted to know that because return of capital distributions tend to be more tax efficient than other types of distributions. And so, just regular income distributions. And the answer is yes, XLEI does utilize return of capital, ROC, in its distributions. And in fact, ROC makes up the majority of its payouts so far in 2026. The clearest evidence coming directly from State Street's own distribution breakdown notice for the June 2026 payout. According to the fund's official distribution source report, 100% of June 2026 distribution was return of capital. 100%. 92.84% of all cumulative 2026 distributions year to date were return of capital. That's a pretty high number for the ROC. This is exactly what you'd expect from a covered call ETF. Option premium income is often classified as ROC for tax purposes. Why XLEI shows so much ROC? Covered call ETFs frequently distribute ROC because option premiums are not always treated as income for tax accounting. The fund may distribute more than its realized gains. ROC can be a tax-efficient way to return option premium to shareholders. ROC does not necessarily mean the fund is losing money. It simply means the distribution is not classified as income or capital gains. What ROC means for you. Tax perspective. ROC reduces your cost basis in the ETF. It is not taxed in the year received. Taxes occur later when you sell shares via capital gains. This is similar to how JEPI, JEPQ, QYLD, and other option income ETFs behave. Bottom line, yes, XLEI uses ROC, and currently ROC is the dominant component of its distributions. This is normal and expected for a high yield covered call ETF built on volatile sector like energy. The next question I asked was how ROC affects long-term total return. And the short answer, return of capital, ROC, doesn't automatically hurt long-term total return, but it changes where the return shows up. ROC can be neutral, beneficial, or harmful depending on why it's happening. Below is a clean, structured breakdown you're looking for. Core takeaway, ROC itself does not reduce total return. What matters is whether the ETF is generating enough real economic return. Option premiums plus dividends plus underlying price movement to support its distributions. Healthy ROC equals tax-efficient distribution of options premiums or unrealized gains. Unhealthy ROC, fund is paying out more than it earns, slowly eroding NAV. Covered call ETFs like XLEI usually fall into the healthy ROC category. So what ROC actually does, return of capital distributions are not taxed in the year received. Reduce your cost basis. Shift taxes to the future. When you sell, do not indicate a loss unless NAV is falling because the fund is over distributing. ROC is an accounting classification, not a performance metric. How ROC affects long-term total return. When ROC is neutral or beneficial, this is the typical case for covered call ETFs like XLEI. ROC is beneficial when it comes from options premiums, NAV is stable or rising, the fund is not overpaying distributions, ROC is simply a tax-efficient way to pass through income. In this scenario, total return equals NAV change plus distributions. ROC does not reduce total return. You get tax deferral and smoother income. This is why JEPI, JEPQ, QYLD, XYLD, and now XLEI often show high ROC, but still deliver reasonable total returns. And when ROC is harmful, ROC becomes destructive when the fund pays out more than it earns. NAV declines year after year. Distributions are funded by selling underlying shares. This is the classic yield trap scenario. In that case, total return suffers. High yield is an illusion. ROC is literally returning your own capital. Some leveraged MLP funds and poorly designed covered call products fall in this category. And how ROC interacts with XLEI specifically. XLEI's ROC is option premium driven, expected for a covered call ETF, not a sign of NAV decay so far. It's only been around for a year, not even a year. Tax efficient for income investors. Because XLEI writes calls on XLE, most of its monthly distributions are classified as return of capital, even though they come from real economic income, options premiums. This is the same pattern seen in these other income ETFs. The ROC is a feature, not a bug. The real question is, does ROC reduce future growth? The answer is indirectly yes, but not because of ROC itself. Covered call ETFs cap upside. That's the real trade-off. You get high income, you give up some long-term growth. ROC is just a tax wrapper around the trade-off. How to evaluate whether ROC is healthy? Look at NAV trend. Flat or rising NAV, ROC is healthy. Falling NAV, ROC may be destructive. And so we'll look at, hasn't been around a year, but right here, it starts at around 24.95, 7/30/2025, and increases. It increased in March during some activity in the Middle East, and then it peaked there, 28, 27, 28, and then it dropped again, and then it's kind of been going up and down for the last few months. So obviously we had some increased oil prices in in March, and then some increased stock prices. Oil prices have kind of been fluctuating since then. But during the time period when the oil prices were low, it was maintaining its NAV fairly well, 24.85, 24.72. So even when the oil prices were low, it was maintaining its NAV. Obviously the NAV went up when the oil prices went up, but then it dropped a bit. So it's only been around a year, but it's been maintaining its NAV. So that puts it in a healthy, even though you're getting like over 16%, it's still doing a good job. It's still a healthy ROC at the moment. I mean, it's kind of a high ROC at over 16%, but so far so good. So anyway, so then distribution sustainability. If distributions is equal to options premium income, if distributions equal options premium income is healthy. If distributions are greater than income, destructive. Total return versus benchmark. If XLEI total return is equal to XLE minus expected call premium drag, it's normal. If XLEI total return is far below expectations, you got a problem. Bottom line, ROC does not hurt long-term total return by itself. It's simply a tax classification. For covered call ETFs like XLEI, ROC is expected, tax efficient, usually healthy, not a sign of decay unless NAV is falling persistently. The real driver of longer term return is the covered call strategy, not the ROC. And I think this is the last question, whether ROC is good or bad for income in investors. I was interested in that. The answer is here's the cleanest way to think about it. ROC isn't good or bad. It's a signal. For income investors, ROC can be very good, very bad, or completely neutral, depending on why it's happening. Below is the structured breakdown that actually helps you make sense of it. Core takeaway: ROC is good for income investors when it is tax efficient income. ROC is bad when it is disguised capital depletion. Covered call ETFs like XLEI, JEPI, JEPQ, QYLD, XYLD are overwhelmingly fall into the good category. When ROC is good for income investors, this is the case for most option income ETFs. ROC from option premiums, XLEI's situation. When ROC is simply the accounting classification for option premium income, it is tax efficient, not tax this year, predictable, sustainable, not harmful to NAV, not a return of your own money. This is the intended behavior of covered call into ETFs. Why it's good. You get high monthly income. You defer taxes until you sell. You control the timing of capital gains. NAV stays stable if the strategy is working. This is the same healthy ROC pattern seen in JEPI and JEPQ. When ROC is bad for income investors, ROC becomes harmful when it is used to mask an unsustainable distribution. This happens when the fund pays out more than it earns. NAV declines year after year. Distributions are funded by selling underlying shares. Yield looks high, but total return is low or negative. This is the classic yield trap. Why it's bad. NAV erosion reduces future income potential. Total return collapses. You're literally getting your own money back. The yield is an illusion. Some leveraged MLP funds and poorly designed high-yield ETFs fall into this category. How to tell good ROC from bad ROC. This is the part most investors never learn, but it's the key. Check NAV trend. Flat or rising NAV is good ROC. Falling NAV, bad ROC. Compare distributions to actual income. If distributions is options premium, it's healthy. If distribution is greater than income, it's destructive. It kind of equals. I don't. Compare total return to the benchmark. If XLEI is equal to XLE minus expected call premium drag, that's normal. If XLEI massively lags, you got a problem. Look at the fund strategy. Covered call ETFs. ROC is expected and usually healthy. Leveraged yield products. ROC is often destructive. For XLEI specifically, XLEI's return of capital is option premium driven, expected, tax efficient, not a sign of NAV decay so far. So I've been around less than a year. Normal for covered call ETFs. In other words, XLEI has ROC is good ROC and not destructive ROC. The real trade-off is in ROC, it's upside. Income investors often misunderstand this. ROC isn't the cost. The cost is capped upside. Covered call ETFs pay high income, reduce volatility, underperform in strong bull markets, outperform in flat and choppy markets. ROC is just a tax wrapper around that trade-off. Bottom line, ROC is good for income investors when it comes from options premiums, NAV is stable, total return is reasonable, taxes are deferred. ROC is bad when NAV is eroding, distributions exceed earnings, total return collapses. For XLEI, ROC is a feature, not a bug. It's a tax-efficient income, not capital destruction. So it'll be interesting to see what happens, like if this ceasefire that's going on between Iran and United States and Israel, if that holds for a while. We can anticipate some of these, oil prices dropping a bit, going back to where they likely were before the war started, and then likely this trend here will probably continue. Where it seems like this ETF pays out almost all of its income in dividends, monthly, and the NAV doesn't increase all that much. So it'll be it dropped a little bit. I guess that was today, last few days with the news. So it'll be interesting to see what happens, and we'll keep an eye on this and go from there. Obviously, people are going to need to have energy in the form of oil for cars and for various things. Anyway, like I said, and another thing, so we discussed XLEI today, and the other one, it's good to, international income ETFs. It's good. Sometimes it's good to diversify because you don't know. So it's hard to know exactly which sector is going to perform well at any given year. So sometimes some sectors perform better, and sometimes some sectors perform worse. And so I think it's good to have a little bit of diversification, because if you don't, then sometimes you don't have, like, if you're all in on one stock or one ETF and it's not doing well, then you're gonna be an unhappy camper. But if you've got some things that are doing well, then you got something to be happy about, and it's just a lot of times, like in the stock market, you don't know what's going to do well year in, year out. So that's why I diversify. I think it's good to basically it makes my portfolio hard to it makes it more indestructible. Let's put that. I mean, it's not perfect, but it makes it tougher to lose money. Anyway, hope this was helpful, and I hope you are enjoying your day.